Mark Newton of Fundstrat highlights one corner of the market that's breaking out and what it could mean for the S&P, and Steve Kovac on the big move in C3 AI, plus Dom Chu on First Republic ahead of its earnings report after the bell today. Welcome to you all. Mark, for you to set the scene for us a little bit here with the broader market. Been talking about how either this is kind of an unimpressive bull market since October, or it's a really non-scary bear market for the last few months. Do we have to make a definition, and what's your general take here on the tactical positioning?
Well, markets have been up the last 4 to 5 weeks, but it doesn't feel that way to a lot of people, and that's what's important. Technology has started to wane a little bit, and so that makes the market seem a little choppier. We have had really good movement in sectors like healthcare, utilities, but really the rotation has gotten a lot more defensive in the last month at a time when sentiment has gotten more optimistic. So April tends to be one of the best months of the year, and I still think trends are positive in the near term. But as we go into May, I think there is a heightened chance that we could finally see, the much awaited correction that I think a lot of people are waiting on. And it should prove short-lived, but there are some warning signs that are creeping up on the horizon.
If that's the case, Mark, I mean, you mentioned the outperformance that has been showing up in some of the more traditional defensive sectors. Is it time to follow on and participate in those moves at this point, in any of those that you saw? I mean, we have some pretty good earnings in the last several trading days from some of the big consumer staple stocks, for instance.
Yeah, I like healthcare as really the best of any of the defensive sectors, because there are parts of healthcare, of course, that are a little more risk on, like biotechnology and really medical devices. But you see, eco-weighted healthcare right now is on the verge of breaking out of a pattern versus the eco-weighted S&P going back over the last couple of years. Now, this is not immediately evident when you look at charts of XLV, but it does really highlight the movement in some of these subsectors when you look at a non-market weighted type ETF, when you look at eco-weighted. So a lot of pharma stocks, a lot of the medical devices, we've seen recent really good movement in stocks like, Medtronic, of course, and Boston Scientific, and that's really an excellent area to position in. And really the pharmaceutical area also, I think, is phenomenal. So it makes a lot of sense to me. Tech has had this big run up. There's no saying that tech can't work for the year, but certainly it makes sense to consider maybe some diversification at this stage of the rally, just given what we've seen.
And I wonder about CocaCola. After reporting decent earnings, there was an initial positive response, and then the stock is now backed off during the day today, and it's kind of bumping up against what's been the upper end of a trading range. How would you assess that one?
Well, the Coke, if you look at it over the last few years, it has actually broken out of a pretty lengthy downtrend. It is one of my favorite consumer staple stocks right now. I do like the stock. I think it likely moves back to all-time highs. So it is right to favor Coke technically. I've heard a lot of the fundamental reports have also been quite positive. So technicals are starting to mirror the fundamental names and really acts very, very well, technically speaking.
You mentioned that, the banks sector has obviously been a bit of an albatross on this market, and it kind of creates ammo for both bulls and bears. Or you could say, if you're bearish, you said no real sustainable rally has tended to continue if the banks are outright weak, as they have been over the last couple of months. On the other hand, the overall tape has managed to hold together even with that drag from the bank. So is there opportunity in bottom fishing there, or would you sort of say this is a broken sector for now?
Well, in an intermediate term basis, I would say it is broken. I say there are some excellent large cap banks that have rebounded quite sharply that do still look attractive. And a lot of those, like the JP Morgans, the Citigroups, the Bank of Americas of the world, they've shown some really excellent signs of rebounding off those lows. It's really the regional bank area that is tried to stabilize a little bit, but it hasn't been that convincing to me yet that this is really a go-to area for intermediate term long investors.
And in terms of a possible further pullback into May, as you say, maybe we're setting up for, what would be a kind of acceptable level of pullback from here? Because, since October, there have been a couple of retreats in the S&P 500 that did not really wipe out all the previous rallies. So I'm wondering how we would kind of frame out what a pullback might look like.
Yeah, trends are still intact. We would really need to get down under 3940 in the S&P cash index, and that would be a big concern that we could see further weakness. 3,800, of course, is the larger level for intermediate term investors. That cannot be broken without thinking trends are turning a lot more bearish. I don't expect that needs to happen, but I think that a move down to 39.40 to 4,000 is certainly a possibility in the month of May. And as of yet, we don't really have sufficient signs to say that it's underway just yet. So we could get to 4,200, if not above that, before we see even a minimal pullback.
Yeah, so that would only be like a 4 to 5% drop from here, even if we did get it. And then finally, Mark, a lot of folks a bit alarmed at how calm the market has been and the fact that the volatility index is around in the 16s, seeing that as a warning sign as opposed to a reflection, I guess, of just a steadier market. How do you read it?
Well, implied volatility never works like people expect. The VIX is going to slowly trend lower and markets are stable or sideways like they have been in recent weeks or going higher. So, the VIX truly reacts when you have unexpected news such as the bank crisis, and that can cause, a big spike. I still view volatility and really the VIX is likely, pulling back even further, probably 15.5 to 16.5, and that will set up opportunity, I think, for those to buy implied volatility, after this big move. It has been cut almost in half, right, over the last, month and a half. So there could be opportunities for those, but we're sort of grinding sideways and really waiting for some catalysts. As you mentioned, tech earnings could be that, or the Fed's end game for rate hikes and how that materializes. I still see there's a lot of larger negativity, but it's really in the short term where sentiment has gotten a little bit more optimistic when you look at things like fear and greed, AI, and some of these investors' intelligence polls that make me a little bit concerned that really might revert to its seasonal tendencies, which is usually down about 0.2% on average.
Right. Yeah, has been a little bit of a chase in the last few weeks, I guess. Mark, great to talk to you. Thanks so much.
Thanks, Mike.